My name is Jake, welcome to the channel. In today's video, we're gonna do a Review My Pie video where I review subscriber portfolios. It's one of my favorite series here on the channel. I like to engage with all of you, and I love reading your emails and seeing how different people view the topic of dividend investing. I get so many different questions. I hear so many different ideas, how people are tackling this idea of achieving financial independence through dividend investing. Because at the end of the day, that's really what it's all about. At least that's what it's all about for my wife and I. If you're new to the channel, my wife and I, we live down in Austin, Texas, and we're looking to achieve financial independence and retire early, but with a little bit of a twist. If you've heard about the FIRE movement, usually people talk about the FIRE movement with the 4% rule, right? Where you sell a portion of your portfolio every year and you live off of that. With my wife and I, we're trying to build a dividend portfolio that generates cash flow in the form of dividend income, and it's paying us a growing dividend year over year so that we don't have to sell our shares. Now, I do these Review My Pies every couple of weeks, and I really enjoy doing it. Now, I know there's a lot of you that have particular questions that I'm not really addressing maybe to a broader audience, or you have a unique situation. If you would like to schedule time with me to review your portfolio or to review your investing approach, I'd be happy to jump on a call with you. I do this a couple of times a week, and I try to make the cost affordable and comparative to what I see other people charging here on YouTube and just in the industry in general. So I try to make it as affordable as I can. But if there are questions that you have and you really want to bounce off ideas, or you're just concerned that you want to make sure that you're making the right decision, I'm happy to jump on a call. I do it via Google Meet. And so if you want to share your screen, we can share a screen. And I actually turn on my video, so it is a video call if you would like. So if you're interested in that, I will leave a link in the description below. And also really quick before we dive into the video, this video is not sponsored by M1 Finance, but if you do want to sign up to M1 and transfer your account like I did, it's a very seamless process. I will leave a link in the description below. It does not cause a taxable event if you're doing a true transfer, and it only takes a couple of days. So I wouldn't recommend this if I didn't do it myself, and I just see a lot of value in it. And so if you want to check that out, I'll leave a link in the description below. Okay, in today's Review My Pie, what we're going to do is we're going to review, or I'm going to answer a subscriber question that I got here recently. And then the first portfolio is going to be from a 31-year-old here in the US, the second a 23-year-old here in the US, and then the third a 65-year-old from the US. I've looked through my emails. I can't see a lot of international portfolios. So if you're outside of the US, please submit your portfolio. I'd be happy to review it in a future video. And as always, everybody, the timestamps will be in the description below, as well as the portfolio links will be in the description below. And as always, everybody, this is not financial advice. It's just merely for your entertainment. I'm really excited about today's video. I hope that you are as well. If by chance you're having a bad day and you're having a rough time, just know that there's always somebody out there that has it worse than you and that's having a harder day than you. And it could maybe look a little like this.
This is Pinky. He's a male cat, domestic short hair. He's available for adoption. He's pet of the week, Placer County Animal Shelter. He's a very loving cat.
Hang on to us, please. Oh, here. Pinky.
Pinky.
Pinky. Whoa. Whoa, whoa, whoa.
Well, we got a wildcat on our hands.
Dude. I think he's caught up in there. Just disconnected from the deck.
It's the one and only Digo Double.
Oh my gosh. Oh, Pinky. Oh man. All right, cool. So this question that I got here was actually from someone here on Instagram. And so I want to read the question and I'm going to try to answer it the best that I can. So he writes here, "Hey Jake, first off, I really want to thank you for your videos. They are great help to me and have provided me a ton of insight into my investing strategies. If it's all right with you, I have a question which I would love to hear or to have your opinion on. I've recently come across Johnson & Johnson, so J&J, and have come to like it as a dividend growth stock. However, its capital gains and dividend growth rate are not as high as I would like. I do plan on adding to it into my portfolio as a source of stable and consistent income in the future when I am closer to retirement. Hence, I'm currently in a dilemma if it would be better to buy Johnson & Johnson now, especially at the lower prices, and let it appreciate on its own, or to just leave it for now and focus on higher growth growth dividend stocks. And it looks like he's in a 30% tax bracket where he's from. First off, this is a really good question, and it's not just unique to Johnson & Johnson. When you think about dividend growth rates, you think about different individual stocks. You have to understand that companies are growing differently, right? They're growing at different paces. Let me give an example of Costco versus Coca-Cola, right? I think most people are familiar with the companies, at least here in the US. Coca-Cola, very established company, sugar water drink, right? It just increased its dividend by 4.5%. It's growing much slower, right? And then you think about Costco. Costco is seeing exponential growth. They're growing their dividend by over 10%. But the thing is Costco has a much lower starting yield today, but it's growing its dividend much faster. So that dividend snowball with Costco over the long term is going to be much greater, but in the short term, not so much, right? And that's why I talk so much about time horizon on my channel, because that's really what it all comes down to. So really, when you're thinking about these different types of companies or businesses, you have to understand, okay, is my time horizon short or long term? And it's all relative depending on, what situation you're in. With Johnson & Johnson, I think you hit the nail on the head when you said here that it's stable and consistent. The reason why I personally would own Johnson & Johnson in my portfolio is for the stable and consistent income. You can rest assured that regardless of what's going on in the macro or micro economy or wherever you're at, whatever's going on, Johnson & Johnson is very, very likely going to continue paying that consistent dividend, right? And there's a reason for it. It's because it has an economic moat. It's because they have pricing power, because there's a fundamental need for their products and services, okay? Now, not every company can do that. So if you hold an individual company like Johnson & Johnson, you have to understand why you're investing into it, because with Johnson & Johnson, you're not going to get rich overnight. Okay, this is a slow growing dividend growth stock. It is growing, but really the thesis behind investing in a Johnson & Johnson is for that stable and consistent income. It's not to get rich overnight, and you should not expect to see exponential growth in the dividend over time. Okay, and especially because they're going to be spinning off their business units here in the very near future. And so Johnson & Johnson is going to be spun off into two different companies. This is pretty common lately. So understand that as well, that the Johnson & Johnson that you've been investing in the past is going to change. They're going to split into two separate companies. Okay, so something to consider. But that's something that you have to understand when you're thinking about a company like Johnson & Johnson. You could always add it later. So if you have a long-term time horizon, that being 15 or 20 plus years, it would probably be more beneficial to add a company like Johnson & Johnson later in life, especially if you're in a taxable account. It'd be much better to hold a company that is growing its dividend faster and has a lower starting yield, for many reasons. One, for the growth that you're going to see, and two, for the taxes. The taxes eat away at your total return, and that's something you want to be very cautious of. So I hope that helps. You could replace Johnson & Johnson with any other slow-growing, mature company or business like an IBM, like a Verizon, like an AT&T, and kind of bucketing those type of companies in that category versus a company maybe like a Costco or a Microsoft or an Apple that are growing obviously much faster. So thank you so much for the question. I hope that helps. All right, let's take a look at the first portfolio here from Ivan. He writes, "Hi Jake, my name is Ivan. I just recently started investing about 2 years ago. I've had this idea of tracking the top 20 holdings of SCHD, which make up about 70% allocation of the fund out of the top 20 holdings. I removed companies that I don't really like to invest in. 30% of my allocations are invested into VTI. Here's what my current portfolio looks like. I hope you see this email and will be able to give some comments on it." You also sent me another email that you are 31 years old and you have a 20-year time horizon. Okay, so this is cool. I actually like the idea. I like the strategy. This is something that I did many years ago when I first started learning about dividend stocks. I went and I looked at the best indices, the best ETFs, the dividend ETFs like the DGROs, the SHDs, the VOIMs, VIGs, etc. And I looked at the top holdings and I started there. All right, so let's take a look at your portfolio. We can't see the whole historical performance here, but what we can see is you have a very low expense ratio, you have a low dividend yield, and only 17 holdings. So right off the bat, I actually really like this. So you said that you have a 20-year time horizon. This is in a taxable account, right? If you're 31, that means you're going to be looking to tap into the dividend income here in your early 50s. So I like this. You got VTI in here at 30%. And then you got Microsoft, Apple, and then you got the others here all equally weighted at 4%. Okay, a couple of things. So right off the bat, you know this if you follow my channel. I don't like having any one individual holding more than 5%. It's just, in my opinion, it's just unnecessary risk. It's not something that you need to do. Now, if you have other investment portfolios, and this doesn't represent 5% of your overall, your holistic portfolio, then it's completely fine. But if this is your one and only portfolio, I do not like having more than 5%. It's just, if you follow my channel, you've heard me say it a million times, it's just unnecessary risk. And I always get some smarty pants in the comments that Warren Buffett does it, but I got a news flash for you, buddy. You're not Warren Buffett. So don't compare yourself to Warren Buffett. The next thing here is with VTI. So VTI is a great index. It's a great ETF. The thing that you want to understand when you're thinking about VTI is, what is the purpose of VTI in this portfolio? What is your goal with this? Are you planning on living off of the dividend income in retirement from VTI? Or are you planning on selling VTI in 20 years and then buying more Pepsi or more Coca-Cola, right? So if you're thinking about living off the dividend income from VTI, you're going to need a lot of money. So you're going to need to have million plus dollars to reason, this is all subjective. So take everything that I say with a grain of salt, right? I know some people that live in a van down by the river, but like with inflation, with costs rising, it's going to be very challenging for the normal person to live off of the dividend income from VTI unless you have millions of dollars invested. Okay, so that's one thing to be aware of. In my opinion, if you're planning on living off the dividend and never selling your shares, considering just having SCHD in here or a DGRO may be something to consider. Just something to throw out there. It's important to understand. So if you and I were talking one-on-one, I would ask you this question. Well, what is your plan with VTI? What do you want to do with this? Why are you holding VTI in here? And then I would go back and forth with you and try to understand why, and then kind of give a recommendation or things to consider based off of the information that you provide. Okay, so that's one thing that I would Ivan, make sure that you understand what your goal is there. Okay. Overall, I really like holding VTI in here because it gives you options in the future to maybe reposition, rebalance, buy a house, buy a car. There's a lot of goodness that comes with that. In terms of the other holdings in here, you got a lot of well-established companies, right? You got the Home Depots, the JP Morgans, the Johnson & Johnson, Broadcom. The thing is like all of these companies are so different. And what I love about this is you get a true balance, right? If you compare Costco and AbbVie, like very different investments. You compare Johnson & Johnson and maybe an Apple, very different. Amgen, okay, interesting. You got Altria. Okay, so all in all, I really like this approach. I really like balancing it out and equally weighting your holdings. This is something very similar to what I do. What I would consider doing is there a possibility that to even add SCHD and DGRO in addition to this? Would it make sense? Because let me plant this seed in your head here for a second. This is what the current makeup of SCHD is today. If you look back a year ago, the makeup of SCHD looked fundamentally different than it does today. Okay? If you look back a year ago or 2 years ago, and a year from now, 2 years from now, the makeup, the holdings, will look very different as well, because this is a market cap weighted index. And so that's why I love market cap weighted indexes, because in 10 years, you have no idea if Broadcom is still going to be in the index or if it's not going to be in the index. And by holding the index, for example, SCHD, you don't have to pick the winner. You don't have to pick the winner. It's survival of the fittest. And that's why I love investing into ETFs. And so that's why I would encourage you or anyone, when you're thinking about this type of portfolio, having your core be maybe a little bit more ETFs, right? SHD, DGRO, VYM, whatever your preference is. But I would highly encourage you to consider that. Now, if you don't want to do that, that's completely fine. It's not for everyone, but overall, this is a really, really great strategy. I'm a fan of it. Some things to consider. I hope that this was helpful. Thank you, Ivan, so much for sending over your portfolio. All right, let's take a look at the next portfolio. It's from Alex. He writes, "Hey Jake, I am 23-year-old civil engineer making $70K a year. In civil engineering, the growth of my income is exponential as I get into my 4th year of working, since that is when I get my license, currently finishing up my 1st year. Also, the safety of civil engineers' jobs is really good during a recession, so I am not terrified of me putting a whopping 25% of my income into my portfolio right now, since everything is at a discounted price right now and the foreseeable future, and I currently live a very minimalistic lifestyle. The problem is I want to ensure I'm making it count. Here is my breakdown. So you have a Roth IRA and you have a Robinhood account. So you don't, there's no links in here. It's just in the email. So you have a Roth IRA, 12.5% into Disney, a slight gamble, 50% down as of sending, hoping for dividends to come back over time, 25% SEHD, 37.5% VOO. So VOO is the S&P 500, and 25% in realty income. I always pronounce that wrong. Realty income. And then you have a Robinhood account with 20 years. Okay, so you're 23 years old. You're 23 years old, and there is a lot of stuff to unpack here. Okay, so I want to start with saying a couple of things. First off, you're investing at 23. You're already winning at life, right? You have a degree. I'm assuming you have a degree. You're in a career where you can see exponential growth in your income, and you have a long time horizon. Okay, so when you think about it, with your Roth IRA. Let me be very candid. Can I be candid with you? I'm gonna be candid with you. I don't like your Roth IRA. I don't like it. And let me explain why. Now, it doesn't matter if you're making 70K a year, 50K a year, $1 million a year. Funny. $100 billion, right? I don't care. The thing is you're 23 years old. You're not going to touch this money in your Roth IRA for a very long time. Okay, until you're 59 and a half at the earliest in most cases, right? Unless you want to pay a fee, a penalty and all that good stuff. So first off, with Disney, the slight gamble, I mean, you can invest into Disney. It doesn't have to be a gamble, right? If you're already right off the bat thinking it's a gamble, why even do it? I mean, unless, everybody to each their own, right? But here's the thing. I don't like 25% into one single real estate, one REIT, right? As great of a REIT as Realty Income is, over the next, 40 or so years, 35 plus years, that's just way too much risk. It's just an unnecessary thing to do to put so much money into one single stock, right? It's just so much risk. Why risk it? So what I would recommend you do is consider lowering your allocation to Realty Income. If you really want access or you really want exposure to REITs, you could check out the Vanguard, real estate ETF and VNQ. For example, you could have like 20% in VNQ, and then if you really like Realty Income, you could put 5% into it, right? Sure, go for it. Disney, 12.5%. I mean, as you fund your IRA over time, over the years, you can always decrease that percentage, right? You can invest more and more. Okay. So the moral of the story here is you need to understand the rule of 72. Okay. If you're hearing the rule of 72 for the first time, pause this video, go and Google the rule of 72. Okay. The rule of 72 is how quickly an investment is growing. Okay. And how quickly it's doubling. With Disney, it's a growth stock. Yeah, it's probably going to do well over time. SEHD growing very quickly. VOO, S&P 500 growing very quickly. Realty Income, it's growing quickly, but you might be able to get a little bit more growth than Realty Income, right? Realty Income is focused on retail, right? And retail is not growing as quickly as other sectors. And I don't think retail is going anywhere anytime soon, but I think there's other opportunities out there. I think it's a missed opportunity to put so much in Realty Income. So I would rethink how you do that. Okay, let's take a look at your taxable account. Your taxable account, so for the next 20 years, so that means by the age of about 43, you're looking to live off of this portfolio. Okay, so you got 10% into bonds. I'm not familiar with HYG, so I'm not 100% sure about that one. I haven't checked this one out. Disney at 10%, McDonald's, Realty Income, QQQ, SEHD, SPHD, the Vanguard Growth. Okay, not familiar with this one, and I'm not familiar with this one. A couple of things here. So first off, I'm not going to tell you to buy bonds or not buy bonds. All I would encourage you to do is ask the question, why? Why are you adding bonds in here? You're probably, if I could take a guess, you're probably adding bonds because that's what you think is the right thing to do, right? You go on any investing blog, you talk to any financial advisor, they're always going to say, have a portfolio mix of bonds and stocks, right? That's at least what I used to think. Really, there's no reason, in my opinion, to even consider bonds unless you plan on rebalancing the portfolio, selling the bonds when stocks are down and bonds are up, like to rebalance. That's one option. Or another reason is maybe you're risk averse, right? And you really want to add that cushion and you don't like the volatility. But if you don't like volatility, why are you invested into these other growth stocks, right? So I don't think it's that. So I would definitely ask the question, why do you hold bonds? Okay. I don't like having more than 5% into an individual company. It's just more risk. What I would always recommend, if you want to keep, these individual companies in here, put them at 5% and then increase your position in an ETF, right? That's how I personally do it. That's how I recommend it to everyone, right? SPHD, I think there's better options out there for SPHD. So the thing that you want to think about, this is more for income. SPHD is for income. You have 20 years. Why do you need income today? Do you need income to pay the tax man? I mean, I'd love for you to pay taxes so we could fix the roads here in Austin. They suck. But you have to ask yourself, well, why are you paying taxes freely and willingly? It doesn't sound like the most optimal way to spend your money or the way to invest. So I would encourage you to rethink SPHD and also Realty Income. It's a great REIT. But here's the thing. This portfolio, now I want you to think about this for a second. I hope that there's a light bulb, so pay attention to what I'm saying. You're investing in this allocation today. Now I want to ask you the question, is this your target allocation for 20 years? Is this what you want your portfolio to look like in 20 years? Or are you going to change it along the way? Okay, you follow me? So if this is what you want it to look like, well, you're going to be paying a heck of a lot of taxes for the next 20 years on some of these, okay? So you ask the question, well, if you have 20 years, why not construct your portfolio today so that it fits your time horizon so that you can optimize for growth and for taxes? Okay. Well, what could that look like? Well, what that could look like is always consider adding these higher yielders later. You don't have to have them from day one. Especially if you understand the rule of 72, they're not growing as fast as these others. So why not add them later? Something to consider. Okay, right? Okay, cool. I can visualize all of the light bulbs going on like, oh, okay, that makes a lot of sense because that's the reality of it, right? So when you think about your time horizon, you don't want to necessarily set up your portfolio. You don't want to invest like you're retiring tomorrow when you in reality have 20 years, right? So something to consider. So I hope that this is helpful. I definitely reconsider the Roth IRA approach. Definitely consider some of these in here. Do some research on the rule of 72. I do like how simple it is. Reconsider the individual allocations, maybe lower to 5%, 3%. There's nothing wrong with having 50% SEHD. There's nothing wrong with adding a DGRO in there to add a little bit more diversification and growth to your portfolio. Just my 2 cents. So thank you so much for sending over your portfolio. All right, let's take a look at the last portfolio here from Thomas, who writes, love your YouTube channel. Thank you for all your education that you've given to us all. Hey, Thomas, thank you so much, man. I appreciate it. My question, I am 65 years old and started dividend investing about 2 years ago. Below is what I currently invest in. Would you change any of the below or just stay the course? Okay, so you got dividend ETFs, 20K each. So these are equally weighted. And then down here, you have dividend growth stocks that you own. They're equally weighted as well with 10K each. Okay. All right, cool. Okay, so let's first take a look at this up here, the ETFs. Now, first off, I want to make sure that, we're talking that you have a plan for a taxable account strategy and a tax advantaged account strategy, right? So for example, you want to hold your non-qualified dividends, if possible, in a tax advantage account like a Roth IRA, if you have access to that. Now, if it's a taxable account, you want to focus on more of the qualified dividend in those accounts. Okay, so something to be very mindful of if you can. Now let's go through these one by one here. So you got Devo in here, JEPI, SHD, SPLG, RYLD, and XYLD. So for those of you that are maybe a little bit newer, let me explain to you how some of these ETFs function. So Devo is kind of like a hybrid between SCHD and an XYLD, right? You get kind of that hybrid approach where the fund managers over at Amplify from Devo, they're writing covered calls on a portion. This is how I understand it. So if I'm saying this incorrectly, I apologize. I don't invest in a Devo, just from the research that I've done, is that they write options on a portion of their holdings, but not all of them. And the advantage of that is you still get the upside growth in a bull market. But because they do write options contracts on some of their holdings, you get a higher yield. Okay, but that yield is going to be taxed. A portion will be qualified, a portion will be non-qualified or considered like a distribution, right? So that's in a nutshell Devo. JEPI is kind of similar-ish, it's a covered call ETF, but they write out of the money options contracts, so there's upside potential. Okay, this is more of a covered call ETF. SCHD is kind of the creme de la creme when it comes to dividend growth ETFs. It's taxed the best. It's the best high dividend growth and high dividend ETF out there, in my opinion, for a taxable account. You got SPLG. This is the S&P 500. You got RYLD. So RYLD is from Global X. They are a covered call ETF that writes at the money contract. So that means that the upside is going to be limited. And this is tracking the Russell 2000. And then the XYLD is also from Global X. They function very similarly to RYLD, but this focuses on the S&P 500. So you got JEPI and you got XYLD that both focus on the S&P 500. Now, this may be a little nitpicky, right, Thomas? But, it's like, well, you kind of got double bubble here. You got some overlap. If you really, really wanted to spread it out, you can maybe look at, a QYLD, or in my opinion, I personally like JEPQ quite a bit better because of the way that they write their contracts where it's out of the money. So there's upside potential. So if I could be a little bit nitpicky, if I were to, say, hey, maybe something to consider, you could consider adding or replacing whatever fits you and your style, this with a NASDAQ, index, because you got the S&P 500, you got the Russell 2000, but you don't have the NASDAQ. So something to consider. And I don't know if I mentioned this is just the S&P 500. Okay, so all in all, I really like this. I like this approach, especially for your time horizon where you're looking to live off of the dividend income now. And one of the big benefits is all of these, except for I believe these two, pay a monthly dividend. So you're getting that cash flow, that passive income on a monthly basis. And that is a big advantage compared to quarterly, with SCHD and I believe SPLG. So all in all, I do like this for your time horizon. A little bit nitpicky with XYLD, but yeah. So let's take a look at your dividend stocks. You got ARCC. Okay, I haven't really looked into this one a lot, if I'm being honest. I've heard great things. People talk highly about it, but I don't personally know it. BTI, I own BTI. They just increased their dividend. It's a tobacco company out of the UK. You're getting a qualified dividend. It's kind of comparable to like Philip Morris. If you're into that, if you're not into sin stocks, that's fine. You got Intel, okay, MFC. I'm not familiar with MFC. Ultra Group is like, you know, the American version of BTI, I guess. Got MPW. MPW is, from when you sent this, MPW is definitely in value territory. Their earnings report comes out next week. I'm holding on to MPW. I mean, there's very few companies that I would not sell if they cut their dividend. Even if they were to trim their dividend, I don't know if I would sell it. But I don't think that, I want to make it very clear. I have no clue if they're going to cut their dividend or not. Steward, their largest tenant or operator, just renewed financing for another year. So I don't foresee a cut anytime soon, but you know, who knows? I don't have a crystal ball. NWBI, not familiar with it. Realty Income, really good. PSEC, I've seen this company pop up quite a bit. I'm not as familiar with it. I can't really give an opinion either way. And then this one, I'm not really familiar either, but a dividend semi-annually, no thanks. But yeah, semi-annually, that's a no-go for me. I personally don't like that. So yeah, Thomas, I think this is fine for your time horizon. Just a few little nitpicky things here or there. Just understand which accounts you have, and understand that, you know, you're not going to get the most amount of capital appreciation from this portfolio, but you're definitely going to get a very good, attractive yield and income, which I believe is probably most likely the goal given your assumed time horizon. Thomas, thank you so much for sending over your portfolio. I hope that this was helpful. Thank you so much for watching, everybody. I hope that the video was helpful. I hope that you learned something new, and I'll catch everybody in next week's video.
So please, whatever, I want to reach 1 million likes. Okay, thank you.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.